Good evening, friends. I welcome you to this virtual CPE meeting on standards on audit, quality controls. I have the pleasure of having with me, in absentia, there is some connectivity issue. Our chairman, CA Lalit Bajaj, who would be shortly with us online. The speakers for today's session, CA Padmashree Crasto and CA Naysar Parekh. The coordinators for this webinar, CA Vanna Dodia and CA Arvind Pandey. Friends, I'm happy to share with you the fact also that the recent three webinars that we have hosted on the standards on audit, two in October and one in November. I would, on behalf of everybody, thank Padmashree for recommending and tying up with all the speakers for these three webinars on the standards on audit. We are all aware the importance of the standards on audit and specifically with the standards with respect to quality control. Let me tell you, for those firms we have who have been subjected to peer review, and even for those who have not yet been subjected to peer review but going forward, that SQC1 is one of the most important aspect other than your audit documentation, which the peer reviewer and the institute would look out for. And therefore we thought it apt to have a session on this SQC1 and also attach with it the SA 220 on the quality control of for an audit with respect to financial statements. And we are fortunate to have CA Padmashree Crasto with us, who would take us through these two standards along with SA 550 on the related parties. Before I would request Padmashree to start, I would request CA Vanna Dodia to kindly introduce Padmashree.
Thank you, Vishal sir, and good evening to each one, and giving me an opportunity to introduce one of the person whom I met a year ago, Padmashree Crasto. She is a partner with Audit and Assurance Practice at MSKB and Associate LLP. She operates out of Mumbai office and has over 16 years of extensive experience in practicing audit services across industry verticals of insurance, financial services, and manufacturing. She is in charge of keeping the audit team well informed of the latest technical developments in the various statutes and regulations, preparation of certain publications for internal as well as external use. She also does the standardization of various reports, templates, work papers for the purposes of the audit. And she's also responsible for quality assurance function in the audit and assurance services, which technical include review of deliverables, conduct of online review, cold review of audit files, and thereby managing firm's risk. She possesses the in-depth knowledge of standards of auditing, both Indian and international, quality standards, methodology, IFRS, company law, accounting standards, Ind AS, and IPO related matters and other statute. And also she possesses the expert knowledge of audit tools. She imparts training programs on technical, quality, methodology, APT, and other matters of professional interest. She has already contributed to WRC publication on anthology of KAM and other reporting matters. It is my proud privilege to present before you a person. She is a Bachelor of Commerce from Mumbai University, and she is also a Bachelor of Law and also done Diploma in System Audit from our institute. Over to you, Vishal sir.
Yeah, thank you, Vanna, and welcome, Padmashree. Friends, in fact, I say that we are unfortunate that we would not be able to see Padmashree because there is some technical issue with our webcam. But at the same time, I would say that we would be fortunate to listen to her today. So over to you, Padmashree.
Thank you very much, Vishal sir, and thank you so much, Vandana. It has been a pleasure. Thank you for the introduction, and it has been a pleasure always working with you, Vishal sir, and interacting with and working with you, Vandana. With actually a very great gratitude, I would like to start this session. We Now coming to the session for today. When we are talking about quality is of I hope everyone can see my screen in presentation mode.
Yes, we can.
Yeah. So when we talk about quality, let's briefly talk about why quality is important. After the time of Enron and after the time of certain heavy audit matters came the importance of audit quality very heavily. Over a period of time, it was necessary to understand what is quality and how to imbibe it, inculcate it into the entire practice. And now, if we say so many years down the line, this is, I would say, the lifeline of any firm. If we talk about SQC1, so today we are going to touch upon SQC1 and SA220. Both are essentially the quality standards, and SA550, which is related party. When we talk about quality in terms of SQC1 and SA220, it's so much heavily on quality that is applicable to all the firms, that it runs as a lifeline of the entire bloodline and lifeline of the firms. If this fails, then everything fails. So internationally, there is ISQC1, and in India we have SQC1. There is a very beautiful implementation guide also, which is published by ICI on this SQC1, which actually gives illustrative policies and procedures as well. So I would say many of the policies that we actually prepare in each of the firms, and we always refer back to that implementation guide, because that becomes our a thorough reference material and a bible, I can say. It's so beautifully made and so beautifully written that I can that I can I actually personally recommend that it should be read by all the people, all the members. Actually, it's very nicely made, so you can get a number of references from there. And in day to day life, since my personal profile is to ensure quality, audit quality and quality of the firm, and also to ensure that the technical updations, that these are the material that I often refer back and forth. Now internationally, if we speak about, if here that's the regulator is now considering revising the ISQC1 framework, in terms of they are thinking of making something which is called as ISQM. So they are actually getting onto the ISQM framework, wherein certain changes based on, because this SQC1 is there in is implemented in 2009 and it is applicable continuously. So something that they have seen changes over a period of time, and certain intricate things that are applicable, they are actually bringing into picture even those things. So ISQM is going to be a larger standard, and that's on the way maybe 3-4 years later. As we had in 2009 the code of ethics completely, um, earlier we had only CA Act regulation, then in 2009 we had code of ethics. Now this code of ethics completely got revised in 2019. So similar is something on the SQC1 as well. However, it is very necessary for all of us to understand what is SQC1 and how it does affect each one of us in running our firms and in ensuring compliance with quality in every service that we provide. Because we as professionals should abide by the requirements of SQC1 at all times. So the title itself is a little bit longer. It says quality control for firms that perform audit that we the important thing that we have to always consider is the quality of these of the services that we provide is the only thing that can keep us running and keep us going at all point in time. So this standard typically tries to and keeps the entire framework of the quality made, and then it ensures that the things have to be in this way, so that appropriate services can be provided. So this standard specifically says that the firm should establish a system of quality control. So it's not about getting a ISO certification, but what our peer review or QRB or any kind of reviewer does is, one, they look into the specific files, but they look at the overall quality system of the firm. So basically that long list of 67 68 questions that you have in terms of a QRB or in terms of a peer review is nothing but questions arising from SQC1. So it's necessary for us to understand and what is the requirement and what is the expectation, so that we can meet the expectations and live up to the expectations in terms of any review. So SQC1 is a standard that applies to all firms irrespective of the size. So it's a framework. So if you are into CA profession in India, then SQC1 is applicable to us. So it applies to all firms. But it depends the operating the guidances or the operating nuances that may be faced by smaller firms is well covered in terms of how the structure is, and then there are certain things that are inbuilt into the standard which actually makes it easier for the smaller firms also to function easily. So if we talk about firms with 20 25 partners and all, then they may be having internally all the policies procedures that are made, and they will have multiple partners who will do the who will perform certain roles. But if we talk about partnerships or proprietorships, partnerships with 3 to 4 partners or proprietorship concerns, still this SQC1 is applicable, but then the policies and procedures are tweaked, or there are requirements that actually they can meet up, and then they can be ensured that they can be uh, aware of that they are compliant with the SQC standard. What are the elements of SQC1? uh, Main elements, these are the 6 elements that we are going to discuss today. So these are the elements that are there in SA 220. Now what's the difference at SQC1 and SA 220? SQC1 is the broader framework which is applicable at the firm level, so it is, I can say that it is entity level control. And SA 220 is again engagement level. So this is ALC and that is ELC. So sorry, this is ELC and that is ALC. So this is entity level control and that is activity level control. So that means when we put a framework at large, then SA 220 you can say is a smaller standard and which is more specific towards each engagements. Elements are similar, but they are actually, in short, you can say replica of this standard in many ways. So that's inside the SA series. And if you're not doing or if you're not following SAS, that means if you're doing something other than SAS, that means review engagements, SREs or SRS. uh, so if you're even using that, then the SQC1 applies. So SQC1 applies to all the standards of auditing when it is being followed, that is when you're doing an audit, whether it is general purpose financial statements, special purpose financial statements. So the SA series from 200 to 800, plus it is also applicable, SQC1 is also applicable specifically to SRS and SRE, which is review engagement 2410, 2400, 4400, and so on, and also the compilation engagements. So SQC1 is a larger framework that applies to everyone. Coming to SA 220, it is sitting inside the SA series. So the length and breadth of that standard is up to the SAs. It doesn't extend to SRE or SRS. So that's how it can be looked into. Any engagement that falls, that is done by the entity, everything gets covered under SQC1. And any engagement that is actually done as per standards of auditing, SQC1 plus SA 220. Basic elements of this system of quality control. Number one, so we call it as the tone at the top. That is the leadership responsibilities for quality within the firm. It's in Sanskrit there is one saying which says uh, which reads as Yatha Raja Tata Praja. That means the way the king is, the entire population will be similar. That means the tone at the top is very important. When we study history, actually we always distinguish few kings as very good rulers, emperors, and few as not so good, or who was not so very famous or otherwise, or who were not so very popular. Why do we do that? It depends on how they did their administration, what all they did, and how did they went ahead. So it's very similar when we have the set leadership responsibility within the firm, and the tone at the top is right. So this we also see in the COSO framework that we use for internal control. We always talk about the tone at the top. So the tone at the top and the things that have to be set right, and then the entire thing flows down below. Next thing is ethical requirements. Now, Code of Ethics is revised. We'll talk about ethical requirements very much in detail as to what are the things that it has, and what are the things that are, required under SQC1. Third thing is another important thing: acceptance and continuance of client relationship and specific engagements. That we will look at detail, the evaluation and the criteria and the basis and things like that. Fourth is human resources. Yes, human resources are the most valuable asset of any entity. It's very essential. If we do not take care of the human resources, there will be huge implications. Engagement performance. Being a professional firm, ensuring that the good quality is maintained, engagement performance has to have certain norms and standards, and this standard lays down how the engagement performance should be done and what are the checks and balances that you need to have, so that the engagement performance is appropriate and the quality is ensured, that the end deliverable is of a good quality. Next is the monitoring. So if all these things have to run well, you have to have a monitoring function. If it is not monitored, something that a policy is set but is not monitored will not be actually taken good care of. If monitoring is not there, then the processes that are set will go for a toss over a period of time, and it may not function the way it was meant to function. So that is to ensure operating effectiveness of all the things that we have set, and to ensure that the things are in compliance. So few of the things that the standard also says is that the elements of the systems of standard of quality control, that means all these 6 elements should be well documented, and the policies and procedures should be there in place, and everyone should be aware of it. That means it has to be communicated. So if I make the policies and sit with myself and expect that everyone in the firm, 20 people in the firm or 100 people in the firm will know it, it's wrong. I have to communicate. So communication is most important. If we say that, okay, this is the policy that we have made on client acceptance, reacceptance, we should either hold a training, or we should send a communication, or we should do both, so that everyone is aware of that this is what is expected out of me, and they are in compliance with the same. And such kind of communication should describe what is the quality control policy procedure, what are the objectives, and why is it designed, why is it in place, and what is the expectance, what is the expectation. Also, this standard further says that the firm has to recognize importance of obtaining feedback on its quality control system from its personnel. There has to be a feedback mechanism, that okay, this is not dictatorship. We have made some policies and then we have circulated. There has to be a continuous improvement system based on what we are actually communicating, and then if there is a feedback, then we have to further improve the policies or procedures, and there has to be a two-way running system. Coming to the first element, leadership responsibilities for quality within the firm. The first thing is the leadership responsibility. So this standard says that the firm should design policies and procedures which promote an internal culture based on the recognition that quality is essential in performing engagement. So it is not that you can do it and you can go ahead. It's not like that. There has to be a culture. So when you imbibe a culture and when you expect the thing to be followed by all the people, then it is followed by everyone. If you're just imposing something on someone's head, maybe it will fail. But when you are imbibing a culture that is making them understand and appreciate why they are doing it and why is it necessary and why is it essential, then they will have a proper implementation framework and they will be able to appreciate and embrace it in a better manner. It requires that the CEO or the managing partner to assume ultimate responsibility for the firm's SQC. The quality control should be the ultimate, should be the ultimate responsibility of the CEO or the managing partner. Whoever is the head of the firm should be assuming the firm's quality control, uh, responsibility. The firm's leadership, if they have a specific leadership team or the senior partner as the case may be, they can set and influence a culture of quality within the firm. So it's not that the policy is made and it is kept as a spiral binding at one place and no one looks at it. In every walk and talk, it has to be there. It has to be so much imbibed that it is alive in all the things. It should encourage a culture that recognizes and rewards high quality work. So I think in all the firms we have a appraisal system in which whoever has done better quality work and whoever has done better in terms of compliances or adherence to policies procedures, you reward them better. Maybe you give a good rating, you give them some bonuses or whatever. So doing good should be rewarded, not the other way around. Can be communicated by trainings, internal memos, informal document discussions, newsletters, mission statements. So there are n number of ways how you can communicate this culture. It can be through formal trainings, it can be informal discussions, you can send out memos, you can send out guidances. So entire SQC one maybe you will not send out, but then cut it and slice it and dice it into pieces. Then maybe one policy you will send out sometimes, some procedures from that policy you will send out from that from a desk, and then so on and so forth, and you will ensure that there is a proper implementation that is happening. Making a policy is easier. Maybe we will google it out, look at the implementation guidance, and then you can prepare a policy. You'll always face a problem when it has to be implemented. So implementation of policy is not easy, but you have to do it. If you have to do it, then you have to communicate. You have to communicate more and more, then only it will get implemented. If you do not communicate, the policy that you will have made, the implementation will fail. It has to be incorporated in the firm's internal documentation, the training material, partner and staff appraisal, so that it gets reinforced. The entire system of quality control gets appropriately reinforced. So it has to be a repetition over and over, and everyone should know that this is how it has to happen. Say for example, if I have a client acceptance form, so everyone in the firm should know that if a new client is coming in, this is the form that has to be filled in. It has to be signed by so and so person, and it has to be documented. So that's how it should happen. It should not be that only two people know it and then they will only not communicate to everyone, so no one knows it. So you have to communicate, and everyone, maybe from the junior level to the senior most level, should be aware of what are the policies and procedures of the firm. Further, it says that the leadership should recognize business strategy subject to overriding requirement to achieve quality. That means whenever you are running for new business, whenever you are running for getting more clients and things like that, you should never override the requirement of quality. So the commercial considerations should not override quality. If it is necessary that you do not take up certain work because it is affecting you qualitatively, then you may consider giving it up, and that's also a part of ethics as well. uh, The firm's policies, performance evaluations, the compensations, the promotions, everything is towards the determinants of commitment to quality. So the best people are rewarded and the best people are actually put forward, but the rest are not left. The rest are to be trained well so that they ensure and they stand up to that level. There is always in a firm, there are mix of people, some people who are overperformers, some people who are underperformers, some people who are doing the work as is and to the level. So we have to strike a balance and go ahead, and we have to keep the ball rolling so we can identify the super performers, the best performers and otherwise, and then we can train everyone so that everyone achieves that goal. This doesn't anywhere say that you leave the people who are actually not performing well or otherwise, but it says that you have to train them more, put more impetus on them on quality, and then you have to bring them to the said level. Firm devotes sufficient resources for development, documentation and support of its SQC. So this is a very apt statement because it says sufficient resources. What is sufficient resources? If it's a firm with 3 partners and 25 staff, sufficient resources is some of them are taking certain responsibilities and running it. If it's a proprietary firm with 10 staff, then it is what is sufficient for it is completely different. If it's a firm with 50 partners and 600 700 staff, then you may then the requirement of being sufficient is there is an entire team sitting who will ensure that quality is in place. So this it has to be sufficient in the sense that whatever is the size of the practice, it has to be accordingly matching with the requirements. It anywhere doesn't say that 2 people have to do, 5 people have to do, no quantification, but it should ensure that it is sufficient. And persons who are assigned the responsibility for SQC should have sufficient experience, ability and necessary authority. So if you give only responsibility and no authority, so it's a teethless responsibility. That means everyone knows that this person can't harm me or cannot do anything, or no one is going to listen to this person, then the quality function itself fails. The person has to have sufficient authority and responsibility so that certain decisions taken that by that person is respected, and certain decisions that are actually communicated is well respected, and certain actions taken on the basis of it. It's not necessary that, say for example, that person is also given with an authority to take actions, but then he has to have at least sufficient expertise and knowledge, and he has to be given authority so that he can ask people as to why this is done and why this is not done. Coming to the second element is ethical requirement, including independence. Now we all know that in 2019 code of ethics has got you know uh, republished, or it is completely changed. Not completely changed, I would say. It's revised to a larger extent. There are many elements which were otherwise missing in the earlier code of ethics. Now this new code of ethics is trying to cover almost everything, and institute has come up with a very beautiful 3 volume publication. First volume is the code of ethics, but the second and third volume, the case studies plus the CA Act regulation references, those are very handy and very useful. If you want to refer to, those are the best material to go back and refer to. Further, you have this know your ethics publications in each of the WRC newsletters. Plus I think they are also publishing a short video of 2 to 3 minutes which is released every month, so that we are aware of this ethics. Now coming to this standard, what it talks about is the firm has to establish policies and procedures to enable and ensure that the firm and its personnel comply with ethical requirements. What all it should contain? It should ensure that the basic principles, fundamental ethical principles. What are the fundamental ethical principles? Is integrity, objectivity, professional competence and due care, confidentiality and professional behavior. These are well maintained and reinforced by whom? By the firm's leadership That's the tone at the top. Education and training, everyone should be aware of, so that there has to be a policy, it has to be given out, there has to be a training, there has to be forms to fill in. Monitoring, time to time it has to be monitored well, so that feedbacks are taken, so that the lacunas are looked at and corrections are undertaken, and also non-compliances with the policies are identified, and appropriate action is taking. And also there has to be a process for dealing with non-compliance. That's what it talks about, the ethical compliances. Now, coming to the next section, which is independence. uh, this talks principally about establishing policies and procedures to ensure that the firm, its personnel where applicable, should maintain independence as per the code. So in short, so the requirement of the standard is reproduced here. So if I have to sum up, and if I have to briefly touch upon what is the requirement with respect to ethical requirements as well as independence. Number one, the firm has to have a proper policy or with respect to independence. The independence policy should ensure that it contains a cross reference to the code of ethics of institute, plus, say for example, if the company, if the firm is doing audit of listed companies, it should have references to SEBI insider trading. It should by default have references to Companies Act 144. It should have reference to, in case if the firm is doing bank audit or insurance audit, the relevant applicable frameworks. That means bank audit, when you do a bank audit, there are certain restrictions that are put in, that has to be captured by independence policy. It has to capture the IRDA restrictions, it has to capture the 144, and it has to capture overall code of ethics. So all these elements have to be necessarily present in the independence policy. Second most thing is, this is a policy framework. Now what is actionable? Actionable is, there should be procedures that come out of those policies. So the requirement of the standard further is, take an annual declaration of independence of all the partners and staff, that they are independent of the clients that they are working on. And further, in terms of every client assignment, it is general practice that we see in many of the firms, assignment wise independence declaration is also taken. Now why there is an overall independence declaration plus an additional declaration? Because independence is not static, it keeps changing. So some partner who is today, or a director in the firm who is today a decision maker on certain client, some relative who is covered under the definition of relative, his wife or someone, may join a company. If you are accepting the uh, audit of this company, then it may give rise to conflict of interest. So then the next important thing is, what is the procedure? How do you deal with, who deals with the conflicts of interest? What are the conflicts of interest? What do you see as a conflict of interest? All these things are already there in code of ethics. So you have to define a procedure as to how do you check the conflict procedure. And then there can be a form for assignment wise independence declaration. When you accept a new assignment at any point in time, assignment may be an audit, tax, anything. When you accept a new assignment, at that time you should do a verification of conflict of interest, and you should ensure that there are no conflicts that exist, so that you can move ahead. Third thing, who decides whether there is a conflict or not? How is it decided? What are the parameters to decide? What is the material that is referred to? What is the evaluation that has been done? How is the evaluation done? And how is it concluded? This is to be necessary to be documented. So we are going to evaluate at any point in time based on code of ethics and section 144. Sometimes some situations may warrant a legal opinion also. It is given in code of ethics also that you can go for a legal opinion in certain cases. So such things are to be done, and it has to be documented. That's the next requirement. So independence, declarations, verification of conflict of interest, evaluation, documentation. Then the most important thing is monitoring of all these things as to how it is functioning, what is functioning, and whether it is functioning in a proper manner or not. And the next thing is, if there are non-compliances, who is capturing it, How is it being captured? What is the procedure for dealing with non-compliance? So say for example, in certain firms, if there is a breach of independence, the person's rating directly goes down, he's not eligible for promotion, he's not eligible for an increment, he's not eligible for any additional bonuses, and at times, if the independence breach is severe, he may be asked to leave the firm also. So those are the disciplinary actions. I'm just giving examples. Different people may have different parameters. Some people do have monetary penalty also of certain amount of certain amount based on whatever salary percentage or something. And then if there is a repetitive offense, then it is seen as more grave, and then appropriate action is taken. So these are the things that should be there in the firms, and these are the things that should be demonstrated, so that demonstratable, so that the policy with respect to ethics and independence are good and working. So this is about all the procedures that we spoke about, these next 2 3 slides. Now coming to the next element, accept and continuance of client relationships and engagements. Why is acceptance and complete continuance so very important? Acceptance continuance of client relationship is important because if we accept a client with a high risk, then obviously our quality may get affected. There may be a reputational risk. There may be legal penalties if at all there are higher amount of non-compliances. There may be, contingencies, litigations, whatever. So every firm has different risk appetite. It's like we investing in stock market. Each of us may be having a different risk appetite. Some of us may be investing only in risk free bonds. Say for example, I may prefer to invest only in FD and bonds. Someone prefers to invest only in equity, so on and so forth. So there has to be a risk criteria. And then what is there in acceptance and continuance? So this standard says there has to be a established criteria for acceptance and continuance of clients. Let's talk about acceptance. When a new client walks through the door, it's not that you just welcome and then you accept. There are certain things that you have to check. Certain things that you have to check in case of a new client are client's background, that's the entity's background. KYC, there is an announcement of institute with respect to that. So the base essential KYC has to be verified. The third thing is you have to look at the background check of the promoters, etc. You have to see was there any limitation to scope on the earlier auditor. If there are any litigations, larger litigations, you may contact their legal counsel. If the directors or promoters, you can do an independent search. There are software tools available to do a background check also. That also you can use if you want a stringent verification. You can use that. Lay down the parameters on the basis of which you will accept. If there are large tax cases or litigation matters, you may connect with their other consultants, and then you can consult, and then you can take a informed decision. So by doing all this and understanding the entity well, then you step on and accept the client if it meets your risk criteria. Now few of the firms do have tools for this, and few of the firms do this by way of an Excel sheet or a Word document. So an illustrative client acceptance form is also there in the implementation guide. I guess a checklist is there. I think questions are laid out, not the exact checklist, that you can use. And then you can decide your risk parameters of the client and evaluate, and then whether you want to accept or reject. If you accept, you have to have valid reason why you are accepting. If you reject, you should demonstrate why you are rejecting a client which you are not taking up by documenting these criterias and the reasons. Now that's about acceptance. Coming to continuance. What is continuance? Continuance is continuance of the engagement year on year. It may be annual, biannual. Generally, annual is more suited for Indian scenario. So annual continuance assessment may include things like changes in the senior management, change in the entire management structure of the company, change in the shareholding pattern, any major litigations, any new things that were not there in the earlier year, experiences that last year the client did not allow me to put a audit qualification, or we had huge number of arguments around certain accounting treatments. So these may be a rethought to continue the client, whether I want to continue or whether I want to get away from this client, and what are the reasons that I want to get away from this client. So this is all about acceptance and continuance. So some of the firms do have ratings, and when you fill in the form, the ratings are directly thrown out, and on the basis of those ratings, then you actually conclude. Say if there is a rating of, I'm just giving an example, if there is a rating of a rating score of say 50 to 60, then it is uh, a low risk client. If it is between 60 to 70, then it's a 75, then it's a medium risk client, and it has to go to someone else for approval. If it is between 75, it is, if it is above 80, and so then it has to go to central committee or something, risk committee or something. So those kind of policies are there in place across different firms. So whatever suits you based on what is your firm size and what is your requirement, you can accordingly adopt the client acceptance policy. But then these are the multiple things that you need to verify, and these are the multiple things that you need to document. So client acceptance continuance is the next important step which the quality control states, with the standard on quality control talks about. And this is a very essential step, because many of the time we end up at the time of audit reporting, we end up at the thought that why did I accept this client. So it does happen at times. So it's better that you take a thoughtful decision and you weigh your risks and know your risks what you are taking. So that's essential. And accordingly, if it is a high risk client, you may have to put in more procedures, appoint an independent person to review, and then do more procedures. It's not that no one will sign the balance sheet of that client. Someone will sign, but how does he sign? He doesn't just sign. Otherwise, when it is a low risk client, a high risk client will be signed after due care and diligence. So that's where the requirement comes into place, that you maintain the quality. To maintain that quality, you have to have additional checks and balances. It is all talking about not rejecting everything, but at the same time, what is it that you need? So if I have to distinguish, when we go from our home to office by car, all we wear is a seat belt. But if at all, if we are going to travel, if we are going to participate in a F1 race, maybe we have to have more guards and more things to wear, because there is a higher risk. So those guards and those accessories is something that this standard talks about, that as to what is it that you decide, and how is it that you decide, and what are the things that you have to do additional if you are going to drive a F1 car. So these slides talk about all these procedures that I just that we just discussed. And it also says that if at all, in terms of continuance or in terms of acceptance, if you notice that it is high risk or otherwise should not be acceptable, you should have a policy in how do you withdraw, and also how do you resign, or how do you reject a client. Because a policy is not an open door wherein whatever is coming in you are accepting. Sometimes a policy is also measured as to if the proportion of what you have rejected. So if you do not have rejections, then that means your policy is not 100% working also. So that you need to have control on as to what is it that you are accepting and what is it that you are rejecting. Human resources. As we said, human resources is one of the most important element of any entity, firm, company, anyone. So number one, as we are in a profession of chartered accountancy, what is important is that the personnel has appropriate capabilities, competence, and commitment to ethical principles, so that he adheres to the SQC1. So the policies around human resources should address these factors. Additionally, it should have policies around how do you recruit, what are the sources, what are the performance evaluation, what are the criteria, what is the capability, competence, how do you give them career development, what are the criteria for promotion, compensation, and what is the estimation, and how do you run a firm? Basically, what are the number of hours they are working, how do you monitor it, and how do you actually control it? So there is another thing that is more essential. We being in a dynamic profession, every day some new circular is coming, every day some new notification is coming, and we are all running behind so many things. So in some firms we have different silos, wherein someone does audit, someone does indirect tax, someone does direct tax, but we in some firms we do a mixed practice also, where we do everything on our own. So there it is more difficult, because to we have our eyes open in every field. Whatever updates come to us, whatever things that are emerging in the market, we have to be aware of everything. And then we have to actually ensure that all those things are compliant with the client, because we can't leave anything at any point in time that is non compliant with the client. So we have to ensure that all these circulars, all these notifications, everything is read, and then everything is implemented also. We can't afford to miss out anything. Even if a minor thing has come day before yesterday, we have to look at, or even if signing, before signing the balance sheet, 2 hours before, if some new notification comes, you have to be aware of it. So something like ex gratia payment in terms of bank that has come, some IRDA circular, some circular on GST, some circular on income tax. So there are so many things now. 3CD, half of the people have filed tax audit, other half now there is new clauses that have come. What is to be done? So all those things we have to keep so much of our eyes and ears open. We have to have a continuous professional development thing also. So maybe you subscribe to some websites or RSS feeds, where you can get certain things, set certain Google alerts, so that you get topics of your interest, which we all do. But then we have to be so much aware of all those things, and within the firm we have to maintain that culture of sharing the information as to who is doing what. And then if the firm is larger, or if even if it is a network of firms, you can always share knowledge with each other. We can always go to websites and download their newsletters, other articles, anything that is available. So there are platforms like where interactions are possible. There are RSS feeds that can be possible. There are certain subscriptions that we can have, so that we can get immediate notifications. So I think it's very necessary. Now today we are not sitting in a book world, we are completely in a e-world. This seminar, or you can say this discussion session, is also happening through a e-session. There is so many things that is electronic these days, that you have to keep your eyes and ears so much open. And we are sitting in a in a complete arena where everything is just pouring in. Because if I compare in the last 6 months, there are so many changes that has happened. Companies Act amendment has come, GST circulars have come, this in banking there are so many changes, in insurance there are so many changes. Everywhere you open your eyes and there are changes. So it is difficult, and at times we struggle, or we are like octopus holding on to everything with all our energy. So another thing to note is that we can ensure that our people, that is our staff, partners, everyone, we share information, and we also share information that we have heard in certain seminars. So last week I was attending one seminar on another standard, so learned a few things. So maybe I passed on in to my peers or my juniors in my team or entire team, something of that sort. Or if there is a seminar that is being held, organized by institute, so this e-platform has become so easy that all the things can be accessed from anywhere, and can be spoken about, and can be attended by anyone, borderless, so it can be attended by anyone as well. So that's about human resources, as to how do you ensure that certain policies, procedures, promotions, everything are done. And by doing all this, a sense of quality and a culture of quality is very well built. It is also a part of this human resource is also assignment of engagement teams. So say for example, if you have different teams who deal with manufacturing business, FS business, services business, then who is assigned where, who has expertise in what, how is it managed, how is it maintained. All these things become more important if you have a bigger portfolio and if you are doing multiple things. And then if you are single handedly doing multiple things, you will have to demonstrate how you are keeping yourself updated with respect to all these requirements. One of the things the standard also talks about is the application of professional judgment, which is also very necessary. Professional judgment, application of professional judgment doesn't come all of a sudden one fine good morning. We will not realize that okay, I got professional judgment. But then, as we all know, it comes over a period of time, and it comes over as we go on and deal with different situations. So some people are very good and very high expertise or dealt with many situations and don't know, and they are aware of and they know multiple things, and they can be always consulted, and we can take help of them. But so we can make use of their knowledge, and we can also give such consultations in case that is the requirement. The next element is engagement performance. So how do you perform an engagement? So if we have to talk about how do we perform an engagement, starting with the planning stage. So our essays always have step to step approach. So it may it be essay, SRS or SRE, it has a step to step approach. What is the step by step approach? It first talks about understanding the entity. It first talks about planning the work. In planning, there comes understanding the entity, internal control, initial meeting with the management, preliminary analytical reviews. There can be discussions with each of them. There can be process notes. There can be walkthroughs. There can be initial, control assessments. All those things comprise of our planning. So how do you do planning? What are the engagement team discussions? When does it happen? Who identifies risks in the entity? Because we all do risk based audits and risk based engagements. Who identifies all those risks? How does it get, the ideas get exchanged? Who talks to whom, and who is supposed to talk to whom, and who escalates the matter? How do you plan the entire engagement? How do you identify new risks that come over as a period of, like, when you start executing? All those things have to be taken care of. And then in doing all these things, you have to ensure that you are actually complying with all the accounting standards, auditing standards, professional framework, requisite circulars, notifications of various stakeholders, regulators, everything. So how do you plan for the engagement? Then second comes, how do you execute the engagement? While executing, who is doing what? The authority responsibility matrix and the work delegation matrix. So who does what? So say for example, a junior level person is doing control testing, then who is going to review that? Who is going to ensure that there is completeness of data? Who is going to ensure that the queries are resolved? Who is going to ensure that the management is updated? What are the matters that are required to be updated in terms of communication with TCWG? So there are so many questions, and you will have to cover step by step. And when it comes to execution, if there is new thing comes, or if there is a larger identification of any observation, how does it pass through the vertical channel, and how does it reach the partner, and how does he actually discuss with the management, and what is the conclusion? And also in the engagement performance, how is the documentation done? It may be driven by tools, it may be driven by hard copy documentation, it can be folders that are saved in soft copy, forms that are saved. Are there any standard templates that are circulated by the firm? So what is the documentation standards that you're using? How is the work getting documented, and how each of the areas, identification of risk, everything is getting documented appropriately? And how are the overall policies and procedures that are there, and how are they kept updated, and they are kept current? We need to look at all these things while we are doing engagement performance. So it's like complete from planning to conclusion of the engagement itself. Then we are inside that we have to have who will be supervising. So supervision policies as to what is he is supposed to supervise, how much he is watching, what are the things he is supposed to watch, who is going to review the things, who is doing additional reviewers, and everything. All these things are actually getting covered in terms of standards of auditing. So for each of the elements there are a set of standards of auditing. Then there comes an important element of consultation. What's consultation? Consultation is when you have doubt, consult. That's the statement that generally everyone uses. So when you have doubt, you consult. Consult whom? There can be a policy inside the firm to do consultation. What is a consultation for? You come across a matter which is complex and then you want a second opinion. So you can consult inside the firm with another partner or with another peer, or you go outside the firm and consult an independent person. So you have to have a set consultation policy. And then when you are doing that consultation, you have to know what are you consulting about, what is it about, and what are the matter about, and why does it need a consultation. So in many of the firms there are set standards wherein there are like these are the matters for mandatory consultation, and these are the matters for these are the matters on which recommendatory is the consultation. How do you do the consultation? You can do it verbally, note it down, based on consultation, send an email, consult, and then document that. If you have a very formal approach, you may have a ticketing system, you may have a complete written system in which it is there, and so on and so forth. So consultation can be done in all these manner. And then whatever you consult, you have to document. Then the next thing is about differences of opinion. Sometimes there may be a differences of opinion between the entity and between the client and yourself. There can be certain times there is a difference of opinion between the team and the engagement partner. Sometimes there can be differences between team and the EQCR, or the engagement partner and the EQCR. So how do you address it, and which is the view that should stand, and how do you close it? That's necessary to be documented. EQCR. Who is an EQCR? First of all, the role of EQCR is engagement. He is called Engagement Quality Control Reviewer. Now, who is an EQCR? EQCR is a person who has an experience and expertise in a industry, who can give additional views. When do you use a EQCR? For a certain set of clients. Who is the certain set of clients? It may be a listed client, it may be a high risk client, it may be a client whom you see there is another person who should be overseeing this entire function. So you put a EQCR there, or you appoint a EQCR there. So you can set the criteria based on what is required for the respective firm. But when the EQCR is there, he is kind of simultaneously monitoring what you are doing. Now he is not a client facing partner or a director, but he is a person who is actually doing a double check on what are the things. What are the places where EQCR is to be included? In planning, in engagement team discussion, identification of risks, in execution, whichever are the critical areas that should be consulted with EQCR. Audit report, qualifications, modifications are to be discussed with EQCR. And EQCR is equally responsible like an engagement partner, not to the outside world, but to ensure the quality in the engagement. So step by step, he is simultaneously looking at the engagement and ensuring that quality is maintained, and he can give his feedbacks to the team who has to adhere to it and who has to resolve all the queries raised by the EQCR. Documentation of EQCR is very necessary. So documentation of what he has done, what he has reviewed is essential. Essential items are to be required, are to be looked at by the EQCR. In case of a sole proprietor or proprietorship practice, or in case of 2-3 partners practice, the EQCR can be from a other firm also. So if he has the experience and expertise, he can be from other firm also. So that's permitted under the standards. So nature, timing, and extent, all these things we discussed about specifically. Criteria for EQCR, we spoke about the criteria for EQCR, which says that he has to have requisite technical qualification, he has to have a degree to which he can exercise professional judgment, and he should not be the one who should be compromising with objectivity. He or she is not selected by the engagement partner, and he or she does not otherwise participate in the engagement during the period of review. That means he is not a team member as such, but he is a quality controller. he or she does not make decisions for the engagement team. He is not going to make any decisions, but he is going to give all pointers, and whatever pointers or queries that he points out has to be satisfactorily closed. Documentation, everything that the EQCR has done has to be documented, and if there are unresolved matters that can't be left open, it has to be closed. It has to be completed to a logical consultation, to a logical conclusion. If there is any kind of difference of opinion between EP and EQCR, then there can be a consultation. The third person can review independently and then can close. Engagement documentation. We know a lot about documentation. SA 230 talks completely about documentation, and each of the standards of auditing, review, everything talks about documentation. So we do work which is generally intangible. So in order to demonstrate what we have done, documentation is the only savior. Without documentation, we can't survive. So documentation is the core heart of everything, and we have to have thorough documentation. So with respect to SQC1, what it says is the policies and procedures that are set with respect to documentation are to be documented. That means there has to be a policy for assembling the file and for closure of the file. And this SQC1 in its application guidance specifically talks about that the file archival should be within 60 days of the audit report date. So we have to close the file within 60 days of the audit report date. In some other jurisdictions, say for example US PCOB and things like that, it's 45 days, and some other jurisdictions have 30 days also. If you're using a tool, the tool should make the entire documentation read only. If you're using folders, hard files, it should generally be kept in the cupboards or sealed for editing after and before 60 days, that is on the 59th day, and it should not allow anyone to change anything after the 60th day. Reports issued for same subject matter. If two reports are issued for same subject matter, then you should ensure, say for example, group reporting and a statutory audit and consolidation and things like that. You should ensure the entire end-to-end safe custody, integrity, accessibility, retrievability of the entire engagement documentation. So this not only applies to this thing, but it applies across. Then whether it is in hard copy or in soft copy, integrity cannot be compromised, and it has to be ensured that integrity has to be there, so that 59-day archival is mandatory. Who and when and who has created the document, when and who has reviewed the document that is necessary to be captured, whether it is in the form of a tool or a hard form or in a soft form. It should have a preparer reviewer sign off. It has to protect the integrity of the file. Any unauthorized changes should not be allowed. There has to be a policy with respect to retention of documents, as specified by institute. It's 7 years as of now. So there has to be it's a written policy. It has to be a written policy that it has to be retained for 7 years. Then ownership of the documentation, that's like it's our ownership, that it's the firm's ownership. So we have to ensure that it is confidential. So the confidentiality, integrity, ownership, safe custody, accessibility, retrievability, all these factors have to be very much kept in mind, and documentation should be done accordingly. Now the last element, which is the monitoring. Monitoring sits above all, because if all these policies, procedures, everything is well set, but if there is no monitoring, then everything collapses. So the entire monitoring has to be done very well, and the monitoring has to be in the form of, in terms of engagement performance, there can be code reviews. Some people also call it as inspection programs. A sample of files can be selected within the firm, and it can be reviewed for ensuring adherence to the compliance with policies and procedures of the firm, as well as professional framework. So that can be done. Then certain intricate monitoring can be done of each of the policies and of each of the elements and of compliance with each of the elements. That means there can be an independence audit. There can be, you can randomly take some people's demat account and check whether they are holding any shares where they are working. So all these are procedures that are used for monitoring. So monitoring will ensure compliance, and in monitoring, if there are non compliances, you have to have disciplinary mechanism in place as to how do you deal with it. Yeah, this is all what we talked about. And in case of sole proprietors and things like that, you can have someone independent, monitoring or inspecting the files. And then it has to have a systematic approach. There has to be well thought about checklist or something that you should carry, and then you should do inspection. And you should know what is the objective that you want to achieve, what is it that you want to close upon, and what are the things that you want to put in place. So all these things have to be ensured appropriately in the inspection, and then you have to come to conclusions, and the conclusions also has to be communicated well, whether the file is good, bad, it needs improvement, there are things that you have identified which needs to be improved later, and things like that. So recommendations actually results in taking appropriate action, communication of findings, changes to SQC procedures and policies, disciplinary action in case of repeated things. At least annually, the results of this entire inspection has to be communicated to all the partners and staff. So generally, uh, a training or a communication is sent out to say that these are the common review points, and then these are the things that has to be implemented or done away with. In case of complaints and allegations, now who can do the complaints and allegations? Internal person can do or an external person can do. There has to be a policy with respect to how you deal with the complaints and allegations. And when it comes with respect to non-compliance with firm's system of quality control, what are the monitoring procedures you have, and what is it that you can take as a disciplinary action? So disciplinary action, as we discussed, can be ranging from monetary penalty to anything. Documentation, overall documentation. Now this is not engagement documentation, this is overall documentation. The firm should document the entire policies and procedures. It should document, the document should depend on the size, complexity, geographical spread of the firm, and complexity of its clients. So it depends on firm to firm, and it is not static. uh, Anything, it can be hard copy, soft copy, but then the integrity, accessibility, safe custody of the document has to be mentioned, has to be ensured. Now, what is the difference between SQC1 and SA220? SQC1 applies to all types of assignment, as we spoke about in the beginning. It talks about how to develop quality control at firm level, and it also talks about internal rotation of partner after 7 years and maintenance of documents for 7 years. So internal rotation of partner, no partner can sign a larger engagement. You can fix up certain types of engagement, which is basically listed client and all, for more than 7 years in a row. You have to rotate him out and bring in someone else. That's what SQC1 talks about. And SA220 is specifically for historical information audit. That means stat audit, group audit, and things like that. And it talks about how to implement quality policies at each assignment level and not at entity level. That's the difference between the two. So if you look at, I have put in slides of SA220, but I'm not going to, reiterate on these things. If you look at the slides, you will see that it's almost same repetition of the larger one into a smaller one. So that it talked about firm, firm, and firm. Here it talks about EP and ET. EP is engagement partner and ET is engagement team. So if you look at, it puts specific responsibilities. So all those that is done at the firm level, EP and ET has to ensure that it is done at the engagement level. So this is how you go one step further and instill something that is more important at the granular level, so that it becomes applicable to one and all. So everyone knows it. Relevant ethical requirements, independence, acceptance and continuance, assignment of engagement team, engagement performance, direction, supervision, performance, reviews, consultation, EQCR, differences of opinion, in other words, consultation, and the monitoring. This is ditto same, and then ultimately documentation of the entire engagement. That's about the quality standards. So SQC1 plus SA220. Now we go on to the next standard, which is related party. So related party, basically we have classified into three buckets: identification, transaction verification, and disclosure. So we all know the objectives, the responsibilities, and the other responsibilities with respect to related parties, how to disclose and what to disclose, and what are the things that we need to look at. Certain relevant definitions: arm's length price. We know what's arm's length price. It's the same price that at which the product is sold to third party, individual third party, independent third party. Related party, we know the definition of related party very well as per the standard of auditing. Now there is related party is, now we have five definitions basically, right? We have related party defined as per uh, standards of auditing, related party defined as per Companies Act, you have related party defined as per SEBI insider trading policy, you have related party defined as per code of ethics, and related party defined in Ind AS/AS. So who is a related party, how do you look at it, and what are the things is the most strict definition you have to take, because if AS is applicable you will go by that plus the Companies Act plus the SA. If Ind AS is applicable, then Ind AS plus SA plus so on and so forth. And for independence and other considerations, obviously you will go by code of ethics. But code of ethics is simpler because it refers back to Companies Act, so it comes back to square one. But there are still three other things that you have to consider. Identification. How do you identify? You have to check the basic documents. If you are a continuing auditor, what are the changes from the previous or from the previous time? Even in case of new auditor, you have to take the balance sheet and then check like what are the changes, what is the nature of relationship between entity and related party, whether he has entered into any transactions during the period, if so what is the type and purpose and nature. Oh, how to obtain understanding, identify, account, disclose RP relationships, authorize and approve. That means check the authorization and approval. And then also you check the authorization and approval for significant transactions that is outside normal course of business. Whatever, so when you make a list of related party, first step is to ensure that the identification is proper. The proper procedures to identify is through various sources. We all know that we have to look at annual report, we have to look at the declarations of directors, we have to look at the other disclosures that are given to the entity, to other regulators, or to the banks or whoever, and then we have to make a thorough complete list of related party. If there are any changes during the year, then we have to update that. Once we have the master list of identified related parties, then we have to ensure that it is also confirmed and discussed with the entity. Then coming to so these are all the possible sources for identification of information. Many things that we talk about: internal audit report, shareholders register, income tax return, so on and so forth. Then when we are talking about related party, there is always one thing that sits at the top is the identifying of the risk factors. So what is risk factors? The main factor that can be possible is fraud risk factor. What is fraud risk factor in terms of related party? There is always a risk that by colliding with the related party, there can be committing of fraud inside the entity. So who has voted for the transactions, how it is voted, what are the significant transactions, what is the debate among the management on approval, what are the transactions that are actually held during the year, who has verified it, who has approved it, all these things will have to be seen properly. And then if there is any fraud risk factor in a related party, it has to be identified and it has to be communicated. Transactions with related party, we have to inspect the underlying contracts, examine the terms, We have to collect additional evidences like approvals, authorizations, and we also have to see proper accounting and disclosures. And if there is any other external document we have to go for, that is maybe inspecting certain bank and legal information, minutes, shareholder minutes, and regulatory returns, tax returns, etc. And we also have to do a thorough ledger scrutiny, and then look at the transactions that has been held with the related party, and accordingly ask for additional additional evidences. We should also do an independent confirmation procedure with the related parties. Also consider fraud risk factors and inquiries into the management. Any arm's length issue, we should also tell the management to make a complete list of all the transactions, and we should check the completeness, the IP, that is the uh, the information that is produced by the entity. How do we check? And if there are any misses and gaps, we should question as to why it is missing and what are the things that should be done additional. Certain assertions, collect sufficient appropriate audit evidence with respect to arm's length, compare the transactions with the prices of identical transactions if possible, engage expert if necessary. So sometimes it may be necessary to engage some expert, so you can do that as well. Evaluation, then you do a complete evaluation based on the business rationale, effects, transactions, or the financial statements, whatever is clear, unclear, and misstated. What are the key terms and conditions, important elements of transactions that are necessary, and what is it necessary to be disclosed as per the disclosure requirements. Documentation, you have to have a complete list, nature of transaction, board approval, legal confirmations, minutes, minutes of shareholders other meetings, written representation, significant contracts copies, and then whatever is the additional confirmations, etc., that you have to have. Disclosures are guided by schedule 3, it's guided by Ind AS, it's also guided by certain additional norms. Whatever is the disclosure, it has to be given. So broad disclosure that is required as per the standard of auditing is also that the name of the related party, description of relation, description of nature of transaction, volume, any other element, or anything specific that we have to talk about, or whatever is the amounts written off, written back, what is it that is the transaction during the year. If there is any flaws, lacunas, control failures, any fraud risk factors, anything that is being pointed out, or we come to we get a knowledge of any of these things, then we should immediately communicate with those charged with governance. So this is one of the essential elements, the way control failures are to be immediately alerted to the TCWG. This is also an essential element that has to be brought to the notice of of the TCWG. Now, whom to contact for which transaction? It depends on the size of the transaction, nature of the transaction, complexity of the transaction, and the risk factor of the transaction. Sometimes it may be a management, senior management, sometimes it may be an audit committee, and sometimes the board itself. And then the written representations should include how the disclosures have been made, how the identification has been made, and whether there are appropriate accounting and disclosure of all these relationships. uh, Implications: communicate to other members of engagement team, request management to identify, inquire reasons, reconsider the risk, and if non-disclosure appears intentional, evaluate implications of audit. I think with respect to SQC1, SA 220, as well as related party, I think that's all from my side. Any questions, please? Any questions? Hello? Hello?
Yes, ma'am.
अरविंद
हेलो
जी आवाज नहीं आ रही है आपकी.
Yes, yes. मिश्रा जी कोई क्वेश्चन है?
हाँ है.
हाँ, yes, please.
Okay, how to monitor independence other than just obtaining an independence declaration on a periodic basis? You need to set a policy for verification of conflict of interest, and then if anyone reports anything, then that has to be evaluated in terms of code of ethics and other applicable regulations, and then you have to evaluate and then make a note of it. You said a third party can resolve any disputes between EQCR and EP. Who is this third person? So the firm can decide. So in case of a smaller firm, as I gave a example, if it is a firm with 20-25 partners, then there can be another person who can be, senior person who can be appointed to resolve this. And the standard itself says if it is a proprietorship firm or if it's a firm with few partners, then you can appoint another CA firm or an external person for this also. Why should a third person interfere in case of difference of opinion? Because there is a difference of opinion, you need to reach to a conclusion so that you can sign an audit report. Third person is required. So if two people are fighting and then there is no conclusion to it, then it will be not appropriate. So that's why there has to be a third person. Will his view be accepted by EQCR and EP? This is precisely the point. Your consultation policy, in a way, should be giving those authorities responsibilities to the third person, that if he comes up with an independent view, say for example, if you are the EU EP and if I am the EQCR, we both have to accept that person's view. So the policy of the firm, if we both are partners and if it says that if you both are fighting endlessly and if a third person can interfere and provide his advice and then close the matter, then you should take that advice, then we have to take that advice. And that's why he has to be an independent unbiased person or another person in the firm, so that matters come to an end. And it does happen at times that there are differences of opinion. It's not about fighting. I think I used a wrong word. It's not about fighting, it's differences of opinion. So I have a point of view, you have a point of view, we both are having interpretation in a different manner, and we keep arguing. So it has to come to an end and the firm has to accept it. Any other question? Can quality control and review done be maintained in soft copy with date and timestamp? As in hard copy, it may be difficult to demonstrate that QC was done in time. Very much, it is possible. But then, as I said, that certain monitoring when it does can be in soft copy, because we don't live in a world of hard copies anymore. We don't have access to printers and other things. So we can very well, use soft copy, but then audit trail should be available. So you have to ensure that it is after a certain date things are made read only and things are non-modifiable. So those care have to be, because integrity of document is something that the regulators actually come heavily on. So we need to ensure that. Anything else? I see question number 5. Is there a question?
5 में क्वेश्चन नहीं है.
I think this was the last question. Correct, Mishra ji?
सर क्वेश्चन नहीं एक भी. अरविंद सर एक भी क्वेश्चन नहीं है.
Okay. Thank you.
If nothing further, then I would like to close. Thank you, WRC, for providing this opportunity. Thank you, Arvind ji, and Vishal sir, as well as Vandana ma'am as well. Thank you so much.
Yeah. So just for a few minutes, so just a concluding remark. So thank you, Padmashree, for taking the entire session, and I think it
Naysar, you
was
can mute
very difficult.
Padmashree.
Hello, hello. Yeah, so thank you for taking the entire session. It was a very difficult topic, but was explained in a very easy language, and I am sure that the participants who are attended it must have understood things in much better manner, which before this there, and they will be able to discharge their responsibilities in relation to the audits in much effective manner post this session. And I would like to summarize the whole session with the one I would say the punchline which the speaker has just mentioned, that the quality should be the culture of any firm who is doing the audit, and it should not be construed that that we are doing this quality work because of some standards of auditing, or there is some partners pressure, or there is some entities pressure. The quality should be the culture in any of the organization to perform the audit, and that will give the best result for the firm as well as for the entity, which is for the auditor as well as for the auditing. And with this, I would like to present a big vote of thanks to Padmashree from on behalf of all the attendees as well as on behalf of WIRC. And with this, I would request all attendees to give big round of applause for Padmashree, who has done a well deserving job in last 1.5
Thank you so
hours.
much.
Thank you, madam. Thanks. Yeah, and with this we move to the another session, which will be taken by Mr. CA Naysar Parekh. Naysar Parekh, he is a chartered accountant, and has over 15 years of experience in the field of stat audit for NBFCs, manufacturing, telecom, and service industries. Currently, he is associated with Walker Chandok and Company, which is also known as a Grand Thornton, and he is associated as a director. And he looks after the fields of quality and risk management, independence, and capital market group. Before joining this company, he was associated with Deloitte, Haskin and Sales, and Hari Bhakti. Yeah, his last job was with Hari Bhakti and Company LLP as a director, and after that he has joined in Jan 20 as in Volker Chandai. And with this short brief discussion, I would like to hand over this entire session to the Naysar Parekh for the in next 1.5 hours. Over to
Yeah,
you, Naysar.
thank you. Am I audible
Yes. Yeah, you are audible.
and people are listening?
Yes.
Expecting
Yes.
so. So
Yeah.
thank you for giving me the opportunity to present my views of the contents and the requirements of two of the most interesting standards, which was one which is entirely a new standard, relatively new standard, and second which has undergone which has attracted much of the attention mainly because of the reporting requirement which has come into. So that is SA 701 and SA 720. We will look into those. So as we say, disruption is a norm now, and it is more than ever before. And in the sense, now it's time that we change from being reactive to the proactive norm, rather, and because the expectation of the stakeholders, including the regulators, are moving from proactive to the hyperactive mode. So it's now time to change. And with this background, I would like to introduce you how the audit report per se has undergone a change and what is the reason behind it. So if we observe if any financial fraud or irregularity in anywhere in any corner of the world, if it is unearthed, the first question which is being asked by all the users of the financial statement and stakeholder is, who are the auditors? So question arises, are we made the scapegoats for all the financial scams? Perhaps not, and reason for my believing so is, so it is the expectation which stakeholders has from auditors, and we have to now live up to that expectation, and that is why we have to take a step in the right direction. typically a clean, plain vanilla audit report in the erstwhile regime, maybe of a textile manufacturing company or automobile company, or be it IT company or any service industry, it will look verbatim same. So as a reader of the financial statement with little financial background, he will not be able to grasp what exactly has gone into audit. And to give that clarity to him that what exactly has gone into the audit, the necessity to change in the auditor's report has arisen, and IAASB and AASB has taken some steps in right direction in past some years. Even in the earlier regime, if a reader of the financial statement starts reading the report, he would get lost in all introductory paragraph, management responsibility, auditor responsibility paragraph, and by the time he reaches the main audit report, the opinion paragraph, he would be lost. And that's why there was a need to resequence and the paras, and that's what it has been done now in SA 700, which is now revised. So actually, no one is too much interested in a simple pass or fail option, but they are also willing to know what exactly has gone into doing the audit of those financial statements. And this is how it is a step in the right direction, and it is for the betterment of audit in fraternity and to make auditors relevant, audit function relevant globally as well. Now, let us look at what are the benefits of the new reporting requirements. So, it has enhanced the value through overall improvement in the audit deliverable. Mind you, we are not talking about the quality of audit, it has almost remained the same, and there is no need to change that. But overall improvement in the key deliverable of audit, increased transparency in the audit and its results. Because now we will be disclosing what all has been of paramount importance while opining, while doing the audit, and we have to reproduce that in our audit opinion. As well, we have to state what all steps we have performed to check the other information as well. We'll discuss that in detail. An audit report to include information about auditors' photos, and it has increased overall audit photos also. Photos of both auditors' photos, because there is an enhancement in the reporting requirement and enhancement in the financial statement disclosures as well, due to the increased focus by management and those charged with governance on matters to be reported. Plus, there is an increase in communication between auditor and TCWG. Generally, in the earlier regime, generally the discussion used to happen between the auditor and management, or at the max, the executive director. But now, for maybe for some modifications in the auditor's report, people might be discussing it with TCWG. But now, since in addition to the modifications, there is a material uncertainty related to going concern paragraph, there is other information paragraph, there is key audit matter paragraph. So due to this additional disclosures, TCWG are also now more keen to discuss these matters with auditors in a timely manner. So though the requirement of discussing with TCWG has not undergone a change, but now there is an increased vigor in that communication which is required. So let's now quickly see what all are the reporting standards. So in India, firstly, SA 700, it is the mother standard which describes how a plain vanilla audit report will look like. It describes the sequencing of the audit report, and it has undergone a change. We'll see how the new report will look like and how it compared with the erstwhile one. SA 700 is the setting standards, and then there are other standards which helps SA 700 in building the audit report. 701 is communicating key audit matters in the independence auditor's report. It's a completely new standard introduced a couple of years back. We'll discuss the requirement and compliance part of that in detail. 705 and 706 deals respectively with the modifications in the auditor's report and emphasis of matter and other matter paragraph. These two standards has not undergone a material change, but they are equally relevant. And SA 720, the auditor's responsibility relating to other information. This also has undergone a change, mainly because of the reporting requirement, which has now come into place. In addition to this, 143.3 of the Companies Act also states certain matters to be reported in the auditor's report. That includes IFC as well as TARO reporting. IFC is something which has not undergone a change since the time it was introduced. However, TARO is a 2-yearly, 3-yearly phenomena, and it was about to change for the year ending March 20, but it got pushed by one more year. So TARO is again a thing to watch out for the year ending March 21 per se. Going forward, so what has changed in the auditor's report? So first thing is the sequencing, as we discussed. The opinion part is now first para, which is the most important para. As a reader, I want to know what is the opinion, whether it is a modified opinion. Modified can be either qualification, disclaimer, adverse, or a plain vanilla clean opinion. Then affirmative statement of independence and fulfillment of relevant ethical responsibility. So this was always the requirement, but now there is a need to disclose that as well in the auditor's report. There is a good amount of emphasis given on the going concern assumption in the auditor's report disclosures as well. So there are at 3 places it's been talked about. One, in the auditor responsibility paragraphs, we need to mention about the going concern. In the management responsibility paragraph also there is a mention about the going concern assumption and the responsibility of management. And third thing is when there is a material uncertainty relating to going concern, a separate paragraph is now needed to be reported. It will be immediately after the basis of opinion paragraph. Earlier, this used to be EOM, but because of the change in SA 570, that is the going concern, there is a requirement to now disclose it as a separate paragraph under the heading material uncertainty relating to going concern. So there is a shift there. There is a requirement now to identify those charged with governance within management responsibility section itself. So now the management responsibility section and auditor responsibility sections have been expanded. As we discussed, the auditor responsibility paragraph will include key features of audits as well. So that gives a bird's eye view to the reader who doesn't have too much of financial background as to what all will be covered under the audit per se. And a new section is addressing the key audit matters. These are the matters which are in the auditor's judgment were of most importance while doing audit of the current period financial statements. Having come so far, let us now just glance through how the structure has undergone a change. So if we concentrate on this, the report on audit of financial statements revised column. So if you observe in the third title, that is the subtitle column, if we see the title also has undergone a change from report on the financial statement, it is now report on the audit of the financial statement. So such minute changes have also been made. So if we concentrate on the revised format, after the title, addressee and subtitle, the introductory paragraph which was earlier there, now there is no introductory paragraph. As discussed, some portion of introduction will be there in the opinion paragraph, but directly it will start with the opinion. Opinion will be followed by basis of opinion. So even for a clean opinion, it will be there. Then material uncertainty, if applicable, material uncertainty related to going concern, if it is triggered, I mean, if the reporting is there for material uncertainty relating to going concern, then that para will come there, followed by key audit matters paragraph, if it is applicable again, and then emphasis of matter paragraph. In the implementation guide, it is very beautifully given and explained would request all of you to go through those. It is mainly in question answer form, and it is very elaborative and explanatory. It is mentioned that the sequencing or the placement of key audit matter and emphasis of matter paragraph can undergo a swap based on their relative importance. Going forward, management responsibility paragraph would come, then the auditor responsibility and management. As we discussed in the management responsibility paragraph, there will be a separate identification of those charged with governance as well. Auditor responsibility paragraph has also been widened, and as we discussed, there were elements which were already there, but now it's required to be disclosed. Other things, the other matter paragraph and other things remaining same. Having come so far and got the background, now let us see what does SS 700, SS 701 talks about. It is an entirely new standard which was introduced a couple of years back, and it deals with communicating key audit matters in the independent auditor's report. So just to give you a background is to as we discussed, a plain report would give a reader of the financial statement a little idea about how, in what industry company operates and what all has gone into in auditing that company. So to make a reader aware, to enhance the communicative value of the auditor's report, and providing greater transparency about the audit and how it was performed, there was a need to introduce a disclosure standard, and that's why 701 got introduced. Now, these are the methods which are of significant auditor has put significant work into while doing the audit for the current period. We'll discuss the nuances and the details about this about the standard in the later slides. Now, question remains is SS 701 is applicable to which all audit entities or which all entities. So it is mandatory for the complete sets of general purpose financial statement of listed entities. Circumstances when the auditor otherwise decides to communicate key audit matters in the auditor's report, and when the auditor is required by law or regulation to communicate key audit matters in the auditor's report. So it is applicable for listed company, that is crystal clear. Second is the option, and option is available to the auditor. It is auditor's prerogative to decide, even in case of unlisted companies, whether to give key audit matter paragraphs or not. So since it is audit deliverable, audit report is an auditor's deliverable, it will be auditor's decision whether to suo moto give key audit matters in his report. Now there are certain scenarios which we have to analyze as to in those circumstances whether a 701 becomes applicable, and if yes, we have to decide whether to what extent it will be applicable and all. And these all scenarios are very nicely explained in the implementation guide, and I have just tried to put it in a quiz form. So a question will appear and you may just scribble down or just be ready with your answer, and we'll discuss whether you answered it rightly or not. So first question is, does SA 701 apply to audit of interim financial statements or audit of financial results in accordance with SEBI LODR requirements? Because as we know that SEBI LODR gives an option whether to give a reviewed result or audited result. Suppose if a company opts for an audited result, it's a Tata company. So if it is an audited result or audited financial for the quarterly basis, will SA 701 be applicable to that particular result? is the question. So answer is no. So why no is, it is as we have seen in the previous slide, 701 is applicable to the audit of the general purpose financial statements. It is given to the shareholders. I mean, it is for the general purpose financial statement purposes, whereas this SEBI LODR requirement is definitely not a general purpose. There might be a scenario where it is complete in all respects, it is hosted on the website. In those cases, it can be construed as a general purpose financial statement, and 701 may be applicable to those scenarios, but in general, it is not applicable to interim financial statements or financial results per se. The status of listing is to be determined as on which date. So there might be two possibilities. One, an entity which was listed all throughout the year, but on 20th of March, let's say, it got delisted. So only for 3 days it was unlisted. Whether 701 be applicable to that entity. And the second scenario would be entity got listed on 28th of March. So it was listed only for 3 days. So in that scenario, whether 701 will be applicable. So answer is, it should be decided on the basis of reporting date. So as on 31st of March, if an entity is a listed entity, 701 will be applicable. So in our first case, where it got delisted on 28th of March, it will not be applicable, and in the second scenario, it will be applicable. Might be a practical case where a script may be suspended from trading, but the fact remains that it is a listed entity, and therefore it will be applicable in that case as well. Third question is whether SA 701 applies to entities which are in the process of getting listed as at the reporting. There are many cases, many sections, LODR sections as well, which becomes applicable to an entity immediately when it is in the process of getting listed. So in that scenario, whether SA 701 will be applicable to those kind of entities? The answer is no. As we discussed in the earlier question as well, it is the listing status as on the balance sheet date which needs to be seen. If it is not listed as at the balance sheet date, SA 701 is not applicable. Fourth question is, if a company has its security listed on a foreign stock exchange, not in India, only in foreign, is auditor required to communicate key audit matters as per SA 701? The answer is yes, because when it says listed, it is listed anywhere. In India, outside India, doesn't matter. It should be listed as on balance sheet date. That's the only condition. Now that it is a true or false question. Will securities include share only, or it will include shares, scrips, stocks, bonds, debentures, debenture stock, or any other marketable securities of like nature? So will this include all these, or it will include only shares? So the general tendency will be it should include only shares, but no, it is any securities which is listed here. If any of these securities of a company is listed as on the balance sheet date, 701 would become applicable. There might be a scenario in case a private limited company has debt listed, 701 will be applicable to that company as well. Hope now it is clear to which all entities key audit matter, that is SA 701 reporting, is applicable. Now let us move to deciding what is key audit matter, how do we identify key audit matter, where do we report, where do we, in the sense, in the audit report, where do we place it, and documentation. as Padmashree also in her session touched upon documentation, the importance of documentation can never be emphasized more. I mean, in the current scenario as well, we have seen that how regulators are reviewing the work papers, and we have seen the reports of some of the audit firms. And believe me, it's only documentation which is going to save auditors to prove it to anyone. And 230 was there, is there, and will be there. And the golden rule still remains, which we learned on the first day of introduction of audit to us, which is WND, WND. Work not documented is work not done. So it is a paramount, and we should uh, uh, recognize the importance of it, at least now. As we have seen, the audit is not a linear activity. Many standards talk to each other, and there is already, we have seen that SA 570 going concern. In fact, audit report itself is a culmination of all the auditing standards in the report. In documentation 230 we have seen. So we have to keep in mind that audit is not a linear activity, and we have to take a holistic decision while arriving at a audit report. Coming to the definition part of it, so as given under SA 701, key audit matters are those matters that, in the auditor's professional judgment, were of most significance in the audit of financial statements of the current period. Key audit matters are selected from matters communicated to with those charged with governance. So if we just dissect this definition, so it is a matter which is auditor's professional judgment. Now, when the professional judgment word comes, it is not a freedom which auditor has. It is actually the responsibility. In fact, the onerous one, which auditor has to now live with the expectation. So first and foremost is it is a matter of auditor's professional judgment. Second is that were of the most significance in the audit of financial statements of the current period. So there might be a possibility that a key audit matter may be different in the previous year and different in current year, but it cannot be totally different, because uh, these are selected from the risk assessment procedures of the auditor. So if it is related to some particular event or a transaction in that particular year, it can be different, but otherwise, even the implementation guide on SA 701 states that generally uh, key audit matters cannot be entirely different from one year to another year. However, the requirement is to report key audit matters that were most significant in the audit of financial statement of that particular year. And key audit matters are selected from matters communicated with TCWG. Again, an important part. So it is a clear filter which one has to apply. So out of, let's say, 10 matters which were communicated to TCWG, we have to filter out on criteria which we'll see in the later slide. We have to filter out in the criteria, and those remaining few will qualify to be reported as key audit matter in our audit report. Moving forward, determining key audit matters, the auditor shall consider following. So there are three important steps, the filter which we talked about in the earlier slide. First and foremost is that it should be from the areas of higher assessed risk of material misstatements. Second is areas in the financial statements that involve significant management judgment, including accounting estimates. So first is our assessed risk of misstatement as an auditor was higher. Second is areas in the financial statement that involve significant management judgment and includes accounting estimates, because accounting estimates invariably will involve management judgment. 0.5% here and there, and the financial statement disclosure or valuation could be entirely different, maybe more than The difference could be more than our materiality or performance materiality level per se. And third is a simple one rather to identify, which is relates to the significant event or transaction that occurred during that particular period, any significant acquisition or something like that. So this is a 3-step filter which we will be applying on the matters communicated to TCWG to determine out of those matters how many are qualifying as key audit matters. So some examples of matters that required significant auditors' attention. This list is obviously not exhaustive, but just a compilation of some. Significant judgment involved, as we discussed, where the accounting estimates are material ones, and material involves material amount, and 0.5% here and there can cause a big chunk of financial entry. Second would be sufficiency and appropriate of audit evidence available, particularly in the COVID-19 scenario, mainly in the year end 20, where there were challenges which were unprecedented for remote auditing, how to do inventory verification, cash count, and the steps, audit procedures, so on and so forth. So the sufficiency and appropriateness of audit evidence, whether they were available with the auditors, was of main consideration while opining on March 20 financials. Reliance on management assumptions. Can we really rely on management assumptions? Are the management assumptions right in the given scenario? Whether there are any experts needed, for example, in case of valuation of inventory of a diamond company which deals in diamonds, or in case of insurance company, we all know how much we rely on the actuarial valuations and assumptions like that. So if a material amount in the financial statement is represented by the figures derived by relying on the management assumptions or experts, we need to be alert enough whether we have to treat that as one of the matter to be communicated to TCWG as well as a key audit matter. There can be some high risk areas. For example, a listed company which operates a casino. There are at least one listed company which I know which operates in a casino business, which involves high amount of cash. So it's not only controls related to the particular cycle of revenue or cash management, but needs to be seen, but it is of more significance because of the money laundering guidelines or FEMA guidelines and so on and so forth, and any lapses could end up in jeopardizing their going concern assumption as well. So those high risk areas we have to be specially mindful of, which can be industry specific also. Risk of fraud, again in the COVID-19 scenario, this can be most challenging risk which we have to deal with, more so in the year end March 21, because for March 20 there was very little impact of COVID-19 impact, I would say, mainly because it came at the very fair end of the year. So operations per se were not too much of impacted. However, the main challenges were on the subsequent events check-in and the result of those, if any, on the financial statements, plus practical difficulty in conducting audit. But the main impact of the COVID scenario will be felt in the year 2021, and here we have to be mindful of the fraud risk factor as well. We all are aware about that fraud triangle, which is the opportunity, rationalization, and pressure. Opportunity meaning knowledge or ability to perpetrate fraud. Rationalization meaning justification for perpetrating a fraud. And pressure can be of the management as well as of the personnel. Management may pressurize an individual to perpetrate a fraud, and the person may do it to save his or her job or for a promotion or incentive. So that fraud triangle we have to be very mindful of while conducting audit for the 2021 audit as well as reporting on 701. There may be some complex calculations involved again in case of in this scenario wherein there might be a possibility that there are some financial instruments like derivative, etc., where the calculations are complex and it involved a major or significant auditor's time, and auditor might want to consider that as one of the key audit matters to be reported. Moving forward, so what can lead to a key audit matter? I think it's just guiding examples. So if there is any complex accounting policy, significant adjustments during the year, there are some significant control deficiencies, judgments or estimates are involved. These all can be, uh, may guide us to what can lead to the audit matter reporting in our audit report. Having reached so far, now the 3 steps what we discussed here, the areas it should be of higher assessed risk of material misstatements. It should be where the significant judgment is involved, including estimates, and if it is a significant event or transaction or a material amount per se is involved. So if we apply these 3 criteria, and let us see by way of examples whether we feel that this could lead to a key audit matter. These all we'll cover in 3 examples, and all 3 are the matters which are been we assume that these are the matters which have been communicated to TCWG, that is those charged with governance, and now we have to decide on whether these are the key audit matters. So looking into the first example, and while we are discussing, you may also think through your answer, and we can then tally with what I thought about it. So the first example is, I'll just read out for everyone's convenience. Revenue is measured at net of discounts, incentives, and rebates on the group sale. The estimation of discounts, incentives, and rebates recognized based on sales made during the year is material and considered to be complex and judgmental. Therefore, there is a risk that revenue is misstated. There is also a risk that revenue may be overstated due to fraud through manipulation of the discount, incentive, and rebates recognized, resulting from pressure the local management may feel to achieve the performance target. So there are some keywords which we have to look into the scenarios. So let us evaluate in the 3 bucket criteria. So higher assessed risk, whether there is a higher assessed risk. So yes, because the situation mentions that there is a risk of fraud, that there is also a mention that it is a complex calculations. So assessed risk is high. So that is a yes. Significant auditor judgment, again a yes, because estimation of discounts, rebates, etc. is a significant management judgment, and it's of a material amount as well. So when we have ticked in all 3 boxes, invariably it will qualify to be one of the key audit matters to be reported in our report. Hope it is clear up till now. We'll move forward, taking another scenario. So during the year, the group has made 3 acquisitions which resulted in 10.5 million, which is the material amount for the group of goodwill and intangibles which are recognized in the group accounts. Goodwill is allocated to 4 CGUs which are expected to benefit from the synergies of acquisition. Goodwill is measured at cost less accumulated impairments. Mind you, it is not amortization, it is impairments only. The recoverable amount was based on its value in use. Sensitivity analysis were performed around the base assumptions, and there was reasonably no possible changes in the key assumption. So key assumption has remained same over the years. Therefore, no impairments were identified in the current year. These assets are not amortized as we discussed, but are subject to only impairment annually. So now again, let us discuss on that 3 parameters. So assessed risk, I feel is no. Again, it's a professional judgment, and as we discussed, it is dependent on case-to-case basis and may vary from auditor to auditor. So why I feel it is assessed risk is not so high is it says that audit group has made 3 acquisition, gives me a feeling that it is a regular business for them to acquire and dispose of the investments. It is a non-complex thing because the assumptions has remained constant over the years. And second point is whether significant auditor judgment is there. So estimation of recoverable amount and all may be there because there is a judgment involved and it may be significant since the amount is also a material one, which is the third criteria, and they have said that amount is a material one. But having 1 yes, 1 maybe, and 1 no, I would tend to classify it as a matter to be communicated to TCWG, but not a key audit matter. Third and the last example is of a group which has an extensive international operation and obviously has exposure to direct indirect taxes. Provision for indirect tax requires directors to make judgments and estimates in relation to the issues and exposures. In Brazil, one of the group's largest markets, the complex nature of the local tax regulation make it a particular area of a significant judgment. So Brazil is one of the largest markets, and there is a area where it requires a significant judgment. This is also a key judgment due to the group operating in a number of tax jurisdictions, the complexities of the transfer pricing and other legislation. So this is a scenario where in a multinational company, whether we would classify this as a key audit matter. So if we see all 3 are yeses, there is complex issues and laws involved across the globe, judgments and estimates of tax issues in one of the largest markets of theirs, that is Brazil. Transfer pricing judgments, then management judgment is involved. Amount itself is material, it is very evident. So in all likelihood, this will classify as a key audit matter. So hope this now gives a basic idea as to how to determine what is key audit matter and how to zero it down from the matters communicated to those charged with governance. Having done so, having come so far, let us now see how to communicate key audit matter. So we have to describe each key audit matter using an appropriate subheading under the heading key audit matter. Where it will be placed, we have seen in the earlier slide where we have discussed the sequencing of the new report. So it should be below the basis of opinion paragraph. Where there is a material uncertainty related to going concern, it will be after that paragraph, key audit matter paragraph would come. Again, a rare scenario as given by the SA701 itself, based on the relative importance, sometimes the emphasis of matter paragraph may precede the key audit matter paragraph, but it is a very rare phenomenon. The introductory language in this section, that is the key audit matter paragraph, before we start commenting on each individual key audit matters, should state that key audit matters are those matters in the auditor's professional judgment were of most significance in the audit of financial statements. That is of the current year only. We have discussed that. These matters were addressed in the context of the audit of the financial statement as a whole and in forming auditor's opinion thereon, and auditor does not provide a separate opinion thereon. So here it is an important point that we are not providing a separate opinion on these key audit matters separately. So our wording and choice of words also should be such that the reader of the financial statement should not feel that we are opining on these matters separately. We have to just mention what we have to mention. We'll see that. So what we have to mention is description of each key audit matter. So the first these two introductory A and B portion would come, and then for each T audit matters, we'll have to describe these. The description of each T audit matter shall include a reference to the related disclosures, if any, in the financial statements. So if there are any disclosures in the financial statements, it should be cross-linked or cross-referenced, and shall address why the auditor has determined that as a key audit matter and how the matter was addressed in the audit. So we have to only tell them about the steps, how we have dealt with in the our audit. We have to not opine on each and every matter. There are two things which are by their nature key audit matter. What are these two? So any qualification is in itself is a key audit matter. Even material uncertainty related to going concern is also in itself is a key audit matter. Now question arises that if there is a qualification or there is a material uncertainty related to going concern, whether we need to report at both places or we need it is okay, it is auditor's choice to report at either places. So there is a clear guidance given that in such a scenario we have to report that as per those specific standards. For example, in case of qualification, as SA 705 states, that is separately. For material uncertainty related to going concern, it should be as per SA 570, that is by way of a separate paragraph, material uncertainty related to going concern immediately above the key audit matter paragraph. And there will be one reference line in the key audit matter paragraph that these were already there, and in addition to that key audit matters, below are the other key audit matters. So there should be a reference here again. Earlier in the pre-revised SA 570, this material uncertainty related to going concern was disclosed as EOM, emphasis of matter. So now there is no need to, that need is done away with. Now it is a requirement to report as a separate paragraph itself, because it is of such a importance that reader is required to be aware about. Needless to say, but it has been clarified also in essay that when auditor communicates or auditor gives, or rather auditor disclaims an opinion, key audit matter paragraph is not required. That goes without saying, because when we are not able to audit itself, how can we say that on which matter were of higher importance while doing audit? So it is clarified that while in case of disclaimer of opinion, there is no need to give key audit matters paragraph. There are certain exceptions in reporting of key audit matters. Now, what are those? Law and regulation precludes public disclosure about the matter, or when the auditor determines that matter should not be communicated in the auditor's report because adverse consequence of doing so would reasonably expected to outweigh the public interest benefit of such communication. So maybe confusing to understand, but there are scenarios where auditor feels that putting this as a key audit matter paragraph, the benefit what the public derive out of this KAM would be lesser than the harm or the adverse consequence it would create, maybe on the company itself or maybe to the larger population. If the auditor determines that he should not communicate because of this reason, it is allowed and it is an exception in reporting of KAM. Implementation right gives one example as well. For example, a major fraud which was reported during the year, and before the year end it was all resolved, all monies were recovered. So in that scenario, auditor may find it useful or may find it unnecessary, may find it useful to avoid that key audit matter, because it has been now controls have been put in place so that those kind of frauds doesn't recur, and no financial impact that fraud had because everything was recovered. So in those kind of complex scenarios, auditor might determine not to communicate those key audit matters. Again, it is a very rare scenario, and there is a detailed guidance given as to in this situation what should be done. So, for example, in this kind of case, one should obtain a management representation, and if required, those charged with governance is representation, and their opinion as to what harm it would create if this matter is disclosed to the public as a key audit matter. So there is a guidance available regarding what all representations we need to take. Another important thing is we have to strike a balance between what all information we are giving and correlate it with the management. We should not step into the management shoes, indirectly saying that we should not be providing any original information to the reader of the financial statement. Original information needs to be given by the management or those charged with governance. Going forward, as we discussed, the importance of documentation is always there. So in this standard also, there are certain documentation requirements which the standard has given. So documentation is required, simple to understand, it is required at all three stages. One, where we are determining to put something as a key audit matter, we have to document why we document our rationale, why we conclude that it is a key audit matter. When we say that there is no key audit matter to be reported, or there is no additional key audit matter other than material uncertainty related to going concern, or other than the matter which gave rise to qualification, in those cases also we have to document our rationale. And third is what we discussed just now, is when there is a key audit matter to communicate, but when we determine not to communicate because of the scenarios which we discussed in the earlier slide, in the previous slide itself. So in all three scenarios, documentation is must. What are the points we should be keeping in mind? So determination of key audit matter is a subject matter of professional judgment. When given the key audit matters, use lucid language. Technical jargons are not understood by all stakeholders. It should convey the right meaning, and it should not be treated as a separate opinion on that matter. EOM and other matter paragraph cannot be used as a substitute for key audit matter. It is made amply clear in the standard itself that EOM and OM paragraph are not substitutes. These are two different concepts altogether. Again, a question may arise: what if I am a subsidiary, I am auditor of a subsidiary of a listed entity? Because listed entity, parent company auditor needs to report key audit matter even for the consolidated financial statements. So again, it's an auditor prerogative, as we discussed, that it is auditor's wish whether to give key audit matters even in case of unlisted companies. So if auditor deems fit, he gives in his audit report, and if he doesn't deem fit, then as a parent company auditor, one may always ask key audit matter for that particular component as part of group audit instructions. Certain matters which in the COVID scenario we have to be mindful of. We have already touched upon that during our discussion earlier, but we have to exercise additional professional skepticism. Impact of on the operations of the entity. As we said that it was at the fed end of the March 20, but it will have the larger impact in the March 21 year, and particularly consequential impact on the financial statement. I mean that the recoverability of financial of trade receivable in case of company in hospitality industry, or let's say travel or tourism sector, it's really a question mark. Or inventory verification, or inventory valuation in case of a company in, let's say, automobile or textile, for example, where the demand has gone down and textile is trend based, fashion based, so the stocks may be already out of demand. So while inventory valuation and all in those kind of industry, we have to be mindful of. There can be some industry which has benefited out of this entire COVID scenario, maybe a sanitizer company or online education and training company. The parameters would undergo a positive change. So, for example, if we'll discuss that in SA 720 discussion as well. But for example, if company has given projections and based on those projections, the going concern assumption was based, and based on which we have taken our audit opinion, we may have to relook into those assumptions or those projections as well in light of COVID-19. COVID-19 itself may or may not become a key audit matter, but it may lead to many other key audit matters. The point was that. So that was our discussion on SS 701, entirely new standard, which was brought in by IAASB and followed by AASB a couple of years back. And now moving to the another standard, that is SS 720, responsibilities, the auditor's responsibility relating to other information. We all are aware about this standard. It is not a new standard. Has it undergone a change? Answer is yes. And is it only a reporting change? Answer is no. Why? We'll discuss it. So why is the need for this standard? So if we see over the recent years, the financial reporting by the company has undergone a change. The amount of information which a typical company puts in the annual report has increased manifold. And as a reader of financial statement, any stakeholder, when it sees annual report and there is a material inconsistency between the financial statement and the other information, it undermines the quality of the financial statements per se. And also it is high time that readers be aware about our role or our responsibility with regard to those other information. They should not be under the impression rather that this entire book is reviewed or audited by or is signed off by statutory auditors. So therefore there was a need which was recognized by IAASB and AASB, that now there is a need to report also that what is our responsibility as far as the other information which goes in the annual report as an auditor is. So a question arises, which all entities or for which all entities it is applicable. So it is applicable for all the entities. However, there is for non-corporate entities, the reporting requirement is being exempted. We'll discuss that. So what is the new requirement? So it is reading and determining whether financial statement and other information is consistent. So requirement is pretty simple and it has remained same. How scope has increased, we'll discuss. How are auditors expected to comply? So agree with the management, agree what? The timing of making available the financial information, other information, and the content of the other information. Then document the procedures performed and obtain representation from the management. So annual report is generally not a defined term. For listed entity, there is a guidance available. For example, regulation 34 of LODR 2015 states the contents of the annual report for listed entities. For unlisted, for example, private companies, it can be only director's report, which is mainly driven by section 134 of the Companies Act. But for unlisted companies, there is not much guidance or law or regulation which is there. So we'll discuss that, what all to be included in annual report or as other information. So as we discussed, requirement is twofold: whether there is any material inconsistency between the other information and financial statements, and other information and auditor's knowledge obtained in the audit. Now here is the difference. In the pre-revised 720, the requirement was only to read the other information. Now the requirement is to read and consider. That puts more onus on the auditors. It increases auditors' efforts to a larger extent. And auditors knowledge obtained during the audit would not only include the environment in which the entity operates, but also includes understanding of the controls. There are things which are prospective in nature, like future prospects and all that needs to be considered. Second is respond and perform additional procedure if there is a material inconsistency. So if there is a material inconsistency between the other information and financial statements, the road is pretty much simpler. Whichever is wrong, we have to correct it. We have to request management and those are with the governance to correct it. But the path will be all the more difficult when there is a material inconsistency between other information and auditor's knowledge obtained during the audit, because there we have to reassess our risk procedure, we have to carry out additional procedures, and mind you, we are at the fair end of the audit. In the sense, when this other information will be made available to us, it will be some a week before, if we are lucky, a week before the board meeting date or the audit committee date, and it will be a lot of exercise. As we discussed, the reporting requirement is only exempted in case of unlisted companies because their annual report is as such not defined. Maybe they are only financial statements, or maybe they are driven by the industry or sector specific disclosures, and therefore reporting on non-corporate entities is being exempted. Moving forward, as we discussed, we have to agree with the management. Agree with the management what? About the two things is timing of availability of the financial statements, and in case not financial statements, other information, and in case those cannot be made available before the report date, we have to agree with the management that it will be provided as and when it is ready. Here the thing is, our responsibility is only limited to the other information which the management or the entity has provided to us. There might be a scenario where the other information is uploaded on the website. Annual reports are uploaded. So we as an auditor are not required to see and check our financial statements with those uploaded on the website. We have to only restrict our procedures to the other information received from the entity. Also, our procedure is not extended to the other information what they have provided to us, whether the same information got uploaded. So our responsibility is pretty much straightforwardly defined in our standard. Even that HBRL thing, tabs and all doesn't come under our purview of review. The second and most important thing to agree with the management is what will be the constituents of the other information, and these are the prescriptive list which is given in the implementation guide to SA720, that this will all constitute other information. There is this is given in the standard itself, and there is a prescriptive guide of list of documents which are not covered as other information. Request you to go through these, and there are some documents which are not included as other information. For example, there are separate industry or regulatory reports, corporate social responsibility reports, sustainability reports, diversity and equal opportunity reports, and so on and so forth. So those are not part of our purview of reporting on other information. Basically, the documents which go along with the annual report, mainly covering these documents, would constitute other information. Now the question arises as to, is the auditor required to audit other information for the purpose of expressing an opinion on true and fair view of the financial information? The answer is pretty simple, that no, auditor is not required to audit these other information, but the only purpose is to identify whether there is any inconsistency between the other information in financial statement or other information and auditor's knowledge about the entity, as well if there is any material misstatement of fact which is there in the other information. Uh, Objective of audit is not to rectify or settle the other information per se, but auditor can become aware about those uh, information which is wrong in the other information, and maybe material omission of the fact also could be there, and auditor just cannot turn a blind eye to those things and allow his report to be included in the such annual reports. So what is expected in those scenario is that auditor need to communicate with management and TCWG and make them alert that there is some gap. We touched upon a concept of misstatement of facts. So what can be these misstatements of facts? So this is something which has nothing to do with financial statements, but you are aware that these are blatantly wrong statement to make. For example, when the director D&A, director and discussion and analysis portion of the annual report states that the company is the second in the competitors list, industry wide list, whereas we know for sure that it is not second, and the projections or trends or the market share which is given to us for our evaluation is different what is than what is represented in MNDA. And other, for example, a director is shown as independent director, whereas he was not an independent director. Then that is the example of misstatements of fact. Possibility that a director report states that there are 10 plant locations of the company, whereas we know that out of 10, 2 got closed in the month of January itself. So we may want to highlight that to the management and tell them to rectify that or clarify that in so many words. Moving forward, so now we are sort of clear that what is actually other information, and we have agreed with the management when it will be made available to us. If not made available to us before the reporting date, management gives us in writing that they will give us that whenever they are ready. They not only agree that at the time of agreeing the terms in the engagement letter, but also agree in the management representation letter itself. Now let us see how to deal with the inconsistency if it is identified. Uh, Inconsistency can be of two aspects: inconsistency between the other information and financial statement, and inconsistency between the other information and auditor's knowledge obtained. So for auditor's knowledge which he obtained during the course of audit, if it was wrong, then we already discussed that it requires additional audit efforts and so on and so forth. But if there is inconsistency between other information and financial statements, then either of them is wrong. I would tend to believe that financial statements are not wrong because it's been audited by us, but there is a possibility that that can also be a wrong. So how to deal with that? So I just tried to put it in a pictorial thing to make it pretty clear, whereas it is explained in para form in the standard. So there are two possibilities: one, that other information is made available to us before the audit report date, and second is other information is made available to us after the report date. In case it is before, and if we found that financial statements are correct and other information needs to be updated, we have to revise the other information, tell see to it that it has been revised, and the chapter ends there. If management refuses to revise, we have to reach out to TCWG, and if TCWG also refuses, then we have to report in our other information paragraph, which we will discuss in the later slides, or SA 720 gives us a right to withdraw from the engagement also, if that is allowed by law. If financial statement needs to be updated, we have to revise financial statement. Nothing has gone to the outer world because it has other information is received to us before the audit report date, so we immediately revise the financial statements. If management refuses to revise the financial statement, then we reach out to TCWG, and if TCWG also refuses, we may have to consider modifying audit opinion. That is a rare scenario, and also we have to keep in mind our thresholds, our performance materiality, materiality level and all, to determine whether that misstatement really is of so much amount that results into a qualification or a modified opinion. Coming to the second aspect, which is a more complex one, where the other information is made available to us after the report date, and there is an inconsistency. Now the report has gone to public. So if other information was wrong and financial statement was right, we have to revise the other information. We have to tell management to revise other information, review steps taken by management, and ensure that financial statements and audit reports are updated and are communicated to the users of, and whoever was the original recipients, they need to be informed about such change. In case financial statements needs to be updated, we have to refer to SA 560. Even in case of even if case management or TCWG refuses, we have to go back to SA 560. Then we can see there is a linkage. It's not a linear activity. The SA 560, of course, is subsequent events consideration. So, moving ahead, how are we as an auditors expected to comply with these requirements? So, first is, I mean, after performing these procedures, audit procedures and all, how are we going to comply with this? So, we have to take a written representation from the management or the client that the drafts are near final, other information are consistent with the financial statements. In case information is not provided, we have to mention this fact in the auditor's report, and written representation from management that whenever it is ready, it will be provided to us. And as we saw in that part B, we have to carry out those procedures if we receive those other information after the audit report is issued. Separate section, how we have to report these other information in our audit report. So there will be a separate section under the heading other information or any other appropriate heading. Placement, as we have already seen while discussing the overall resequencing of paragraph, it will be in case of listed company where key audit matter paragraph would be there, it would be after key audit matter paragraph but before the management responsibility paragraph. Unlisted company, it will be after the basis of opinion but before the management responsibility paragraph. Of course, in case there is material uncertainty related to going concern, it will be after material uncertainty related to going concern paragraphs. So in case of reporting also, there are three scenarios which is possible. Either the other information is not available at all as at the reporting date, or it is partially available. Say out of 10 things which goes typically in the annual report, management was able to provide only 4 things out of 10 and 6 are remaining. How we have to report that, we'll discuss that. And third is we have received all other information and we have to now opine. So in all three possibilities, when it is not available, it is pretty simple to report because we didn't had anything. But in other two, it depends whether we found any material inconsistency, in the sense when the material inconsistency remained, I mean the management and DCWG refused uh, refuse to correct changes. In those scenarios, we may have to report it in our report as well under the other information section. So there are three possibilities: not available, partial available, fully available. And in partially available and fully available, there is again two possibilities, that it matches or it has material inconsistency. So this is a scenario where we have received all the information prior to the auditor's report. So how typically that other information paragraph would be worded? So it will be a management responsibility. Statement would come that preparation of other information is the management responsibility. Then we have to identify what all other information is. Then we have to specifically amply clear, make it amply clear that we does not state any opinion on this other information. Auditor's responsibility is only reading, considering, and reporting on this other information. So there is no reader is also now aware that we have only read, considered, and reported. We are not issuing any assurance or opinion on this other information. And finally, our conclusion. Conclusion can be two. Either we have nothing to report, I mean everything is hunky dory and everything is fit and span, or we make a statement that describes the uncorrected misstatements of the other information. There is a material inconsistency in the other information we have to describe. We have to be mindful wherever we are issuing the qualified opinion, the matter that gave rise to that qualification, we have to see the impact of that particular underlying matter while reporting under this second portion, that is statement that describes the uncorrected material misstatements of other information. Information not received, partially received prior to the date of auditor's report. So again, other things remaining the same. Important point is this third bullet, which states that for listed entities, we have to identify any information expected to be made available to the auditor after the reporting date. Just to clarify, assume that there are in our as an example, there are 10 other matters. Out of that, only 4 are received and 6 are not received up to the report date. In case of listed company, for these 6 matters which are yet to be received, we have to make a statement in the auditor report that it is not made available and it will be available. It will be made available by the company at a future date. So for listed entity, we have to make that futuristic statement, and for unlisted company, we have to stop at whichever is made available. That is that 4 things which are made available, we need to opine on only on that 4 things. No futuristic statement would come in the unlisted companies other information paragraph. We have to mention that auditor's response, other things remaining the same as we saw in the earlier slide, and only changes for listed entity we have to state that futuristic statement. So as the guidance note also stated, it has to be made in each and every financial statements of corporate entity. There are some other considerations which we have to be mindful of. Again, coming to the documentation. Documentation of the procedure performed under this essay. Final version of the other information also we need to document. In case of disclaimer of opinion, we don't have to give other information paragraph. Like we discussed in case of 701, 720 also is not applicable, not required to be given in case of disclaimer of opinion. Consideration needs to be given to the implications of the matter giving rise to modification in the audit opinion while reporting on other information. This already we discussed in the previous slide. If material inconsistency is identified between the other information and auditor's knowledge obtained in the audit, revise the auditor's risk assessment, and this will be the most challenging task because we will be seeing audit committee in a couple of days, and we would rather run for more time to carry out these procedures. There are some considerations in the in light of the current COVID scenarios. There is a need for heightened professional skepticism application and audit of accounting estimates, particularly related to information given for projections and information given for going concern. Now, why we are discussing this at a SA 720 discussion is assume for a fact that there is some going concern, there is some future projections given in the director discussion and analysis section or director's report, which is not in line with what was provided to us while doing audit, and based on that thing we opined on financial statements. We cleared the going concern assumption for the company, or we decided on the impairment of some of the intangibles which were determined based on the projections given. So we have to correlate those projections with the COVID-19 lens which we have considered in our audit, and this is more particularly for March 21 financials more than March 20. So basically that concludes my views, my thoughts on SA 701 and 720. Open to questions. Thank you once again for giving me this opportunity to share my views.
मिश्रा जी कुछ क्वेश्चंस आए हैं क्या ऑडियंस से?
दे रहा
आई एम श्योर इस टॉपिक पे तो बहुत सारे क्वेश्चंस हैं.
Are there any? Yeah. The first question is, with the increase in the integrated reporting, auditors' responsibilities increase under SA 720. Your views on the same, please. Yes, definitely. Integrated reporting is a new phenomenon. It's a big brother of BRR reporting, business responsibility reporting, and more companies are now marching towards integrated reporting, that triple P we used to call it earlier. So yes, it has increased, but the basic principle would remain the same, that we have to be mindful of all the financial, non-financial information that is going in the annual report, where our audited financial statements, I mean, where we have opined on any audited, we have opined on financial statements, is set in place. We have to check for the consistency of those information. Second is, when reporting the audit matter, do we need to obtain information from management as to why it is a KA? I would tend to this, and I mean, no, we do not have to obtain information. Rather, it is as we say, we have to apply filter process from the matters we have communicated to TCWG. We have to apply those three filters, and we have to now determine what is the KM. So of course, Entire audit is dependent on the information what we receive from the management or the company per se, but we don't need per se any information for giving any KM in particular. We already have those details. We have done audit for the entire year. Third is reporting key audit matter. Is the auditor required to mention as to how management has dealt with key audit matter? Not really. It is disclosure is required only as to why we determine that as a key audit matter, what all steps we have done, and we have to give reference to the disclosures made in the financial statements by the management. In the steps how we audited or how we approached that key audit matter, we may touch upon the management steps, but that will be as a step what we performed as an audit procedure. So, for example, management has carried out a valuation exercise, then we as a audit step would see that management has obtained a proper valuation from an expert who has a requisite qualification, things like that. But per se, we don't have to state how management has dealt with that key audit matter. That key audit matter is our auditor. For non-corporate entities, say LLP, there could be some reports separately by the LLP. In spite of that, other information is not to be reported. No, it's not required. Non-corporate entities, I believe key audit matter is not required to be reported. Question 5 is, for unlisted companies, don't you feel it is better to state that other information which will be made available after reporting date, even if it is not required to be mentioned? Yes, but rather it is not required. So why one should mention that that it will be made available after the reporting date? One important aspect we should keep in mind and sensitize client as well, that if we put that other information was not made available to us by the reporting date, we have to sensitize client that he should not date that other information before our audit report date. Many a times it is the same day. Audit director's report and auditor's report and financial statements are signed off on the same day, which is okay. But if we are reporting that something was not made available to us as on the reporting date, management needs to be made aware of that they can't date it prior to our date. And this is given in the implementation guide 2720, that we should sensitize management that they should be aware about this fact. And there is no need to report. Why to report additionally and invite more trouble? It is okay. Can you please inform again about point on going concern key audit matter reporting? You mentioned that issues on going concern need to be reported under emphasis, while now it has changed. Yeah. So in the pre-revised pre-revised 570, SA 570, whenever there was a material uncertainty related to going concern, we were required to report that as a separate paragraph in the emphasis of matter. As an emphasis of matter. Now, as a 570 has undergone a change, now whenever there is a material uncertainty related to going concern, we need to report as a separate paragraph immediately after the basis of opinion paragraph. So now there is no more a need to give that key audit, no more a need to give an emphasis of matter. We should only give that separate paragraph as desired by 570. Also, 720 guidance implementation guide clarify one pertinent aspect as well. Many a times it is very difficult to discuss with management about material uncertainty related to going concern, and we might not be able to come to a conclusion that there are material uncertainty exists. So we call this as a close call situations. So in case of this close call situation, auditor may determine or may decide to give not the uncertainty related to going concern, but may determine or decide to give the underlying factor which gave rise to that conclusion, or which gave rise to that suspicion about the going concern. For example, any provenant or any material debt which needs a refinancing to be done, which is yet to be approved by that bankers, that particular aspect which hitherto was very impractical for auditor to be reported, now we have key audit matter and we can take help of this paragraph to include that in our report for the user's benefit. One is how to adopt professional skepticism during the audit due to impact of COVID-19. So it's not a bookish thing. One has to use their experience of audit, and there are plenty of material available as to what all things which we have to be particularly mindful about. It may differ from industry to industry, jurisdiction to jurisdiction as well, and skepticism is just to keep our eyes and ears open to what is happening around the world and in the entity itself. And there is no bookish or theoretical uh, guidance available on that. We just have to be extra careful in the COVID scenario. That would be my thoughts on that. Anything else, Pandeyji, Arvindji?
और कुछ है मिश्रा जी? I think Mishra ji? No. Thank you, Naysar ji. Thank you for taking this entire session. And I would say these are the most important topics in the audit field. It is like the audit reporting. I would say the way you have explained, and you have got colors in these topic like your background color, which is so beautifully colored. So I think these topics, as you have explained, is much critical in the reporting. Like, let's say for the example of reporting, whatever you do in the audit, whatever substantive checking or detail checking you do, but ultimately at the end of the year, management and everybody stakeholder sees the audit report. So ultimately how you are reporting in the audit report, whether it in within the limitations of the standards on auditing, whether it is bringing out all what auditors wanted. So audit reporting is also like, whatever, like in whatever you study for 365 days, but ultimately you have to put down in 7 or 8 pages of sheet in the exam paper. So if that is done beautifully, then the whole 365 days is fruitful. So it's the same, whatever you do in the entire audit exercise of 2 to 3 months, let's say stat audit, ultimately the stat audit report is the quality which gets generated from the audit exercise. So I would say you have touched upon each and every important aspects of the audit, right from the execution to the final reporting to the stakeholder. And I'm sure the audience or the participants who have attended it must have gained good amount of knowledge, and it was a tremendous knowledge booster, and it will help them to plan their audit and understand various aspects of the standards on auditing, and it will definitely improve their reporting, their quality, like as explained by the previous speaker, that quality needs to be the part of the culture. It cannot be like it was forced, like that it is sometimes what happens, some of the auditors brings out quality depending upon who is the client, but that should not be the case. Quality should be the part of the culture, should be the part of the firm, and that's why some of the firms are famous because of their quality. And thank you for taking out your valuable time on weekend evening. And with this lockdown and virtual meetings, we are working 24 into 7. So thank you for taking out your time and enlightening on this session. And with this concluding remark, I would say I would like to present a vote of thanks on behalf of myself, from the audience and the WIRC. And with this, I say a round big lot of applause for you. And that's all from us. And thank you. Thanks a lot.
Thank you.